Welcome to Real Turkey channel. This is Atilla Yaşalara. Today I'm going to talk about the central bank's monetary policy decision, which was announced on Wednesday. Governor Gaye Erkan and her teammates in Turkish FOMC, I suppose, or MPC, have raised the benchmark interest rate by 500 basis points to 30%. To me, Wednesday was the day when Turkey honestly initiated war against inflation. I'm not saying this war will be won. If it were up to Gaye Erkan and her nominal boss, economy czar, Mehmet Şimşek, yes, they know how to win the war. But clearly, their decision-making process or reaction function is constrained from many directions. And after all, monetary policy by itself is not enough to combat inflation. That being said, this is also a reaction video, though no one particularly addressed me, or no one in the YouTube community probably know of me in Turkey or in the United States. But most of the reaction to the interest rate decision was negative, and for a very right argument. So I'm going to first start with that. I'm going to explain why is it important to raise rates from 25 to 30% when the ongoing inflation in the country is 60% according to official count, and probably 70% if you ask the men or women on the street. I'm going to give you a lot more details on how at 30% monetary policy will not be effective. But then I want to run to the defense of Ms. Gaye Erkan and explain the constraints she's operating under, as well as, despite the meager or modest rate hike, what she has managed to achieve. Then I'm going to talk about the chances of success in this war, all-out war against inflation. Essentially, I'm going to talk about Mr. Erdoğan, who continues to puzzle me in a positive way. I'm going to talk about the budget, incomes policy, how all of these factors must be coordinated, which at this point aren't. And finally, give you my opinion as to whether in the foreseeable interest rates, Turkey can avert a currency exchange rate crisis in the winter. Now, let's look at inflation dynamics of Turkey. As I've said, headline inflation as of August is 58% or so. Central Bank's inflation report also projects inflation for the year-end and up to 2025, in fact. And there, a year-end target is 60%, and next year target is something like 33% or so. Also, the Central Bank takes the pulse of the experts by conducting a poll each month. It's called expectations poll. You will see it below. And there they ask you about monthly inflation, year-end inflation, current account deficits, etc., etc. There, last week, the latest issue came out, and 12-month ahead inflation expectations were 66%. 1 year ahead, or 2 year ahead, 44%. So you have 30% policy rate, and no matter how you cut the inflation dynamics, it's negative. It's less negative, but it's negative. So why I think this decision is very important and how it might change the course of Turkey's so far ineffective war against inflation. And most importantly, monetary policy is also a component to shock investors and other counterparties. And in that sense, what Ms. Gaye Erkan achieved so far is an astounding success. It's a huge positive surprise, as they say. I mean, a month ago, if you polled any Turkish economist, he or she would have told you the top policy rate for 2023 is probably 25%. There won't be anything done until March 2024 local elections, and then afterwards we will see. It's in the hands of the Lord. Now that perception has changed completely in two ways. Ms. Gaye Erkan, with two bold 500-point basis hikes, dispelled the notion that she's acting under the orders of Erdoğan. I'm not saying Erdoğan doesn't watch monetary policy closely, but at this point I can describe his attitude as benign negligence. For some reason, he doesn't care about monetary policy. He led them to their own device, which is the best thing that can happen in Turkey or in any country, believe me. 2, she knows what she is doing, and even though it's very gradualist, she has a plan to combat inflation. Let's get on with other aspects of this. Now, I have seen one major investment bank issue a report after the central bank meeting, which talks about 42% policy rate at the end of the year. Honestly, in June or July, if you told them that central bank will raise policy rates to 40% at the end of the year, they would call you insane. So in that sense, this is a great surprise. 2, from now on, I can take the monetary policy statements in earnest, perceive them as true because they've been keeping their promise for a few months. And that's very important. If Turkish central bank tells you we're going to fight inflation, you don't change your behavior. If Mr. Powell comes out, or Ms. Lagarde, or Mr. Uezo, I believe, in Japan, and tells you they are determined to erase the inflation problem from the face of their nation, you take that seriously. That affects your economic behavior. When you plan ahead, you project lower inflation because central banks will not allow rising inflation. Now, if Turkey can move to this state of affairs, obviously it will take fewer rate hikes to achieve the intended objective of suppressing inflation expectations and also lowering wage demands and cooling down domestic demand, which seems to be the underlying problem or the primary problem under rising inflation and high current account deficits. And I think we're getting there. She gave Mehmet Şimşek a tremendous weapon in his marketing arsenal to attract financial capital into Turkey. Mr. Şimşek met with investors in New York under the auspices of Goldman Sachs, I believe. But there will be more of those. He'll be going to London, probably Tokyo, Singapore, I don't know. But he has something to sell, to invite people to invest into Turkey, which, in recent history has treated foreign financial investors awfully. Now she has three weapons. A, she has an able central bank governor who is going to raise rates. A few days ago, there would be suspicion about that. Now, there is less suspicion. When he says, look, trust me, we're going to go very slow, but we're going to raise interest rate. Now, there is more credibility. Two, as he claims everywhere, he has Mr. Erdogan's full support behind this program. And in fact, in the past, when Mr. Erdogan disowned all these interest rate hikes and stuck to his low interest rates are good policy, this time he's making shy but repeated speeches about how he trusts Mehmet Şimşek and how he trusts the new economic program. And third, of course, my not last video, the video before that, medium-term economic program, which is sort of an outline or a forward guidance of what the Turkish government will do in the next 3 years to solve the problems and, to advance development. So he now has a better chance of attracting foreign money. Now, the final point, which is not well understood in Turkey, because it's not studied and not well understood in many, Western democracies because it's not implemented, is the second leg of monetary policy, which is the credit policy. Now, if you follow China, you'll, I'm sure, agree with me that China has a monetary policy based on interest rates. Another leg of the monetary policy is playing with banks' required reserves. And a third, making selective credits cheaper, more expensive, imposing more requirements on giving loans to certain industries. It's sort of like a puppet master trying to distribute a limited amount of credit to the sectors that it sees most beneficial for the economy. Turkey has been doing that very actively. And the top TL deposit rate and the top rate on corporate loans were indexed to the policy rate. So when policy rate rises, banks can collect Turkish lira deposits at a higher interest rate. And if corporates or individuals come to get loans from them, they can quote higher interest rate charges. Why is that important? It's important for two things. Because even deposit rates will stay negative for the time being, they are less negative, and there is a higher likelihood that the huge amounts of savings accumulated in FX deposits or in what we call KKM, FX protected deposit scheme, which are actually, quasi deposits. The government gives you an option to convert them to FX at the end of the maturity is the best way I can explain it. And one of the biggest fears is that in the winter, when inflation accelerates and when interest rates remain low, people will migrate from TL deposits to FX, which would destabilize the currency. Our monies that are, the KKM program is being winded down, and the monies that are coming out of there would go into FX deposits. These are still possibilities. They still frighten me at night. But with interest rate rising, that's less of a problem. To give you an example, as of a Friday ago, top TL deposit rate was 45%. With inflation at 65-70, not very good. You still earn negative. But if this rises to 55-60, well, it's less negative, and you might want to take a punt at it. So in that sense, the monetary policy spills over into the credit policy in two positive ways. First, it raises TL deposit rates, so makes TL assets more favorable compared to FX assets for domestic retailers. Two, it increases the savings rate when, interest rates are higher. Usually people save a little bit more. Three, it raises the interest rate on loans, which should limit amount of loans demanded. And of course, with fewer loans, people hire fewer people. People buy fewer investment goods and imports, and both inflation and current accounts start going down, or at least don't accelerate anymore. So now, this is a good start. This is what I mean. Now, today, we're undering, we have put on our gloves and we're punching inflation. Can we succeed? As I've said, if Mr. Erdogan will not interfere, yes, within a year, Turkey will see inflation below 40%. Within 2 years, we'll be down to low double digits. But obviously, this is not the case. The big question still in everybody's mind is how long will Mr. Erdogan show this benign neglect towards rising interest rates when he had resisted them all their life? My answer lies in, politics. Mr. Erdogan's primary goal is to win back big cities like Istanbul, Ankara, Izmir, probably not possible, but Adana, Antalya, in local elections, which will be held in March 2024. And he will do anything that's necessary. In fact, even lowering interest rate again, if that's what his conservative constituency demands. But that's assuming there will be competitive elections. I did a video which claimed that democracy died at the night Mr. Erdogan won elections, and now the opposition verifies what I'm saying. They are in such disarray and in such a nihilistic mood that for them, merging or uniting for local elections and keeping the big cities is an outlier. And unless they can really get their act together, I think Mr. Erdogan will continue not to care about the level of interest rates or the credit shrinkage. So to me, the biggest constraint, Mr. Erdogan will only come into play if he starts dropping in the polls, and that would be, January, February. In March, we have the elections. But you see, even a very harsh, hawkish monetary policy is a very painful tool to end inflation. You want to cut budget deficits by cutting budget spending, and you want to reduce wage demands, salary demands. Now, in Turkey, these two things are not happening. Yes, the Turkish budget demonstrated surpluses in July, August, but that's because Mehmet Şimşek's first act was to raise taxes to collect 4 percentage points of the GDP from people's pockets. This turned out to be inflationary because all indirect taxes were now higher, but also it limited the income in people's hands. But you see, it's not going to work next year because Turkey has this very nasty habit of indexing pensions, government blue-collar and white-collar salaries, wages, and even the minimum wage to accumulate inflation, to past inflation. So if inflation is 60% at the end of the year and it was only 20% in the first 6 months of the year, everybody's going to get a 40% automatic raise. And this obviously is going to raise budget deficits again simply because the government cannot increase its taxes as much just after the one it has initiated 6 months ago. So if this very generous salary, wage, pension, etc. hikes continue at the beginning of the year, we would have wasted a year. No amount of monetary policy could mitigate or turn around that kind of income injection into the economy. Mr. Mehmet Şimşek is now making noises, talking to the ministries to prevent that and to index wages, not the cost of living, but the future expected rate of inflation. If he wins that, I think monetary policy will become much more effective. At this point, I don't know. But look, I think Erdogan is giving Mr. Şimşek, Mr. Cevdet Yılmaz, Mrs. Gaye Erkan more of a playing room, a bigger sandbox, the more success they have. And so far, they have been successful. And finally, even if we overcome all these problems, we have a global backdrop which is very unfavorable to weak credit, emerging markets like Turkey. As of Friday, emerging markets wiped off all equities, wiped up all of their gains for 2023. For the 6th year in a row, they're going to be underperforming developed market equities. Local bonds are selling off, I believe. The currencies are down because the dollar index is, skyrocketing. And in general, there's a perception that they will have debt repayment difficulties because American 10-year bond yields are at 17-year, 18-year highs. So this is the situation in which Turkey will have to attract foreign money and raise new FX loans. It's not easy. Either this situation will change and investors will return to emerging markets, which would make Mr. Mehmet Şimşek's job easy, or Mehmet Şimşek, with the grace of Mr. Erdogan and Cevdet Yılmaz, will be able to craft a very sexy Turkey turnaround story. For instance, by allowing Gaye Erkan to raise rates every month by 500 basis points to swim against the tide. As I've said, these developments reduce the risk of a currency crisis in the winter. I have done a video about 4 videos ago. It says external deficits are going to kill the Turkish economy. I still stick to it. I don't think winter is comfortable, but Mehmet Şimşek is going to be abroad for roadshows to explain investors Turkey's problems and the solutions they have found. It's quite possible that enough foreign investment will come into Turkey to bolster central bank reserves and to mitigate the depreciation pressures on the Turkish lira. Obviously, if you follow this channel, I'll be following up on these stories. I want to thank you for watching and commenting. I enjoy all of your comments, but I'm under a very different and difficult working environment here. I'm away from my favorite and customary working table and working under strange conditions. When I get back to Turkey, which is about 3 weeks or so, I shall be able to read them and comment on them, all of them. If you like this video, subscribe, or send the link to someone who might enjoy hearing about Turkey. This is Atilla Yeşilada saying goodbye on behalf of Real Turkey channel.